All right, guys, here we go. Second attempt. I'm about to shoot myself. The first time I recorded it, for some reason it didn't record, but here we go. Second attempt. Should work. All right, so chapter 6, we're going to be talking about interest rates. Interest rates for bonds or loans. So this is different from the required rate of return that you see for stocks. In stocks, you're not making a loan, you're just asking for a certain percentage return. Here, you're actually lending money out to some entity and you are requiring a certain rate of return for this loan. So this is the nominal interest rate that would be charged on the loan or on the bond. When we talk about bonds, bonds are actually loans made out to organizations, whether federal organizations, state organizations, or companies. Okay, so what determines the interest rate for one of these bonds? Let's go ahead and check it out. All right, so the interest rate, as you can see, is determined by these 5 different components. This is what's called the required rate of return on debt of a security. Debt security would be a bond, okay, or some type of a loan. This is the nominal interest rate on that loan. And that is equal to R star. R star is basically the real risk-free rate of interest. Basically, it's a compensation for time, for giving up consumption today so you can lend out money to someone. This is the real risk-free rate of interest. So I guess the risk-free interest rate is an interest rate that is paid or charged on a risk-free instrument, one that has absolutely no risk, meaning that you're going to get paid regardless. Like there is no chance that you are not going to get paid your interest and the principal that you lent out to this company or this individual. So there are very few investments that are actually risk-free. One of the closest investments that are close to being risk-free is lending money to the U.S. federal government. So the Treasury bill is something that is the closest to the risk-free rate of interest. However, the Treasury bill is not completely free of default risk, even though that's the way we think about it. And the Treasury bill also has an inflation premium included in there. This R star that we're talking about has no inflation premium. It is just the interest rate that is charged on a risk-free instrument without inflation. So the second component that you see is the inflation premium. So whenever we lend money out to someone, we tend to look at what inflation is going to be like over that period of time. If inflation is going to be high, then we tend to charge a high inflation premium. If inflation is going to be low, like let's say 2%, then we add an additional 2% into the equation. So this is the inflation premium. The third component is the default risk premium. With the default risk premium, this is an interest rate or a premium that you would charge to a company that you think is risky. Okay. So for example, if you lend money to Tesla, lending money to Tesla has a higher level of risk than lending money to the US federal government. So because you're lending money to Tesla, you're going to add an additional default risk to it. Now, depending on how risky it is, you might add 2%, 3 percentage points, 4 percentage points, depending on the level of default risk that is exhibited. Companies can and do default on their bond payments, whereas the U.S. federal government has never defaulted on its bond payments. So this default risk premium is that percentage that you would add depending on whether you think that the creditor is not going to pay. Or I'm sorry, the debtor is not going to pay. The next component is the liquidity premium. This liquidity premium is, again, a percentage or a rate that you would add to the nominal risk-free rate. And it has to do with how quickly you can get rid of or sell the bond that you purchased without losing value. So when we think of liquidity, we tend to think of two things: how quickly we can sell the debt or the instrument, and then without having a loss in value or a very insignificant loss in value. If you can sell something very quickly without losing value, then that is a very liquid instrument. If it is hard for you to sell something, I mean, it takes a long time to sell something, and you also have to discount it a lot, then that is something that is considered illiquid or an illiquid instrument. So depending on how liquid this bond is or this loan is, like how quickly you can sell it to someone else, we're going to have to tag an additional percentage to this nominal risk-free, to this nominal interest rate. So again, if you were selling Tesla bonds, they're not going to be as liquid as US federal government bonds. So you want to add an additional liquidity premium to Tesla bonds compared to US government bonds. And then the maturity risk premium has to do with how long or what the maturity of the bond is. Short-term securities have very little interest rate risk, meaning that they're not impacted as much by changes in interest rates because of the mathematics behind how bonds are valued and so on. Whereas long-term bonds are impacted greatly by interest rates, meaning that they have a lot of interest rate risk. Again, this is due to the mathematics of how bonds are valued. So if you're buying or selling a 30-year bond, that bond is going to have a lot more maturity risk compared to a short-term bond. So if it's a 30-year bond, you're going to have to add a bigger premium to it compared to a short-term bond. So those are the 5 determinants of interest rates for bonds or for loans. Not every single bond has all these 5 components. If you think of a US government bond, they're going to have the real risk-free rate of interest included, the R-star. It's going to have the inflation premium included in it. But depending on what it is, it's not going to have the default risk premium. We said that the US government has never defaulted on its loans, so default risk premium will not be in there. It probably won't have the liquidity premium because, US government bonds are very liquid. And as far as maturity risk premium, it might have some of those because, if you're, buying a long-term bond versus a short-term bond, it might have a little bit of that. So a US government bond will not have all these components. But if you look at a Tesla bond, it probably will have a lot of these components. It will definitely have the first 4. And the 5th one, depending on how short or long-term it is, it might have the maturity risk premium. If you're talking about a long-term bond for Tesla, it'll have this MRP. If you're talking about commercial paper is another expression for short-term bonds for corporations. If you're talking about commercial paper, then this maturity risk premium will be negligible. So those are the 5 determinants of interest rates, guys. If you have any questions, let me know during class.